But let me be very clear, holding large amounts of cash in 2026 is not conservative, it's lazy. Cash feels safe, but safety is an illusion when inflation is eating your money every single day. If your cash is sitting still, you are falling behind. Period. In 2026, the rules are simple, that your money must work harder than inflation. Governments will continue printing, costs will keep rising, and cash will quietly lose value while you're congratulating yourself for being safe. Cash loses value over time, and that truth becomes brutally clear when inflation is persistent. When you hold cash, you feel secure because the number in your account doesn't go down. But that's a psychological trick, not financial reality. Every year prices rise, your cash buys less, groceries cost more, energy costs more, housing costs more, education costs more. Your money stays the same, but your purchasing power shrinks. That is not safety. That is a slow, silent loss. Inflation doesn't announce itself loudly. It doesn't send you a warning letter. It just works quietly in the background, reducing the real value of every dollar you refuse to put to work. A 5% inflation rate doesn't sound dramatic, but over time it compounds against you. They'll leave your money idle for 5 or 10 years and you will be shocked at how much wealth you've actually lost without spending a single cent. Many people confuse liquidity with intelligence. They believe holding cash means they're being careful, flexible, and ready for opportunity. But in reality, the excessive cash is often just indecision dressed up as caution. Cash should be temporary. It should be a tool. It should have a purpose. When cash sits too long, it becomes dead weight. The real danger is that inflation is not a one-time event. It compounds year after year. Even when inflation slows, prices rarely go backward. That means every year you delay investing, you lock in a permanent loss of future purchasing power. You're not standing still. You're moving backward while pretending you're safe. The smart investors understand that the goal is not to avoid risk completely. The goal is to avoid guaranteed loss. Inflation is a guaranteed loss for idle cash. That makes holding large amounts of cash one of the riskiest decisions you can make over the long term. You may avoid market volatility, but you cannot avoid the erosion of value. Another mistake people make is waiting for the perfect moment. They hold cash hoping for a crash, a correction, or absolute clarity. But markets reward participation, not perfection. While you wait, inflation keeps working against you. Even if you invest later at a slightly better price, you've already lost years of compounding and income. The time is the most valuable asset you have, and idle cash wastes it. Cash also creates emotional comfort that leads to poor behavior. When people see large cash balances, they delay decisions, chase headlines, and hesitate during opportunity. Meanwhile, disciplined investors are already collecting dividends, interest, and income. They understand that money must produce something. If it doesn't generate cash flow or long-term growth, it has no job. This doesn't mean you eliminate cash entirely. That would be irresponsible. Cash is necessary for emergencies, short-term needs, and strategic deployment. But beyond that, it must be allocated. The cash without intention is financial decay. Cash with discipline becomes power. In an inflationary world, the only rational response is ownership. Ownership of assets that can grow, adapt, and generate income. Businesses can raise prices. Assets can appreciate. Cash cannot defend itself. It has no protection. It just sits there hoping inflation will be kind. The hope is not a strategy. The reality is simple and uncomfortable. If you are holding cash long-term, you are making a bet that inflation will stop, governments will spend less, and prices will fall. History shows that bet almost never wins. The disciplined investor accepts reality and acts accordingly. Cash is not wealth. What cash can buy over time is what matters. And if that buying power keeps shrinking, so does your future. Safety in investing is often misunderstood, and nowhere is that misunderstanding more dangerous than with cash. People look at cash and believe it is risk-free because the number never goes down. There are no red screens, no daily volatility, no headlines screaming panic. But real risk isn't about daily movement. Real risk is about losing purchasing power over time. And cash does exactly that when inflation is present. The illusion of safety comes from visibility. You can see your balance every day. It feels stable. It feels controlled. But stability in numbers does not mean stability in value. If the cost of living rises faster than your cash grows, you are losing wealth in real terms. That loss just doesn't show up on a statement, which is why so many people ignore it. True safety means preserving and growing purchasing power. If your money cannot buy the same goods and services in the future as it does today, then it is not safe. It is deteriorating. Cash offers emotional comfort, not financial protection. It reduces anxiety in the short term while creating long-term damage that only becomes obvious years later. Many investors hide behind cash because they fear volatility. that they believe avoiding market swings means avoiding risk. But volatility is temporary, inflation is permanent. Markets move up and down, but over long periods, the productive assets adjust, prices rise, earnings grow, income increases. Cash does none of that. It absorbs the full impact of rising prices without any defense. The irony is that people who believe they are being conservative are often taking the most dangerous position of all. By refusing to accept short-term uncertainty, that they guarantee long-term loss. That is not discipline. That is avoidance. Wealth is built by understanding risk, not by running from it. Another reason the illusion persists is memory. People remember market crashes vividly, but they don't remember inflation because it doesn't happen in a single dramatic moment. It happens slowly, one price increase at a time, one bill that costs slightly more, one subscription that quietly raises its fee. Over time, those small increases destroy the real value of idle money. Safety also requires adaptability. Cash cannot adapt. It cannot adjust to economic changes. It cannot increase output. It cannot respond to rising costs. Productive assets can. Businesses can raise prices. Real assets can reprice. Income-producing investments can adjust payouts. The cash just waits and hopes conditions improve. There is also a behavioral trap. When people sit on cash, they delay decisions. They wait for certainty that never arrives. The markets reward decisiveness backed by discipline, not hesitation driven by fear. While cash holders wait, disciplined investors are collecting income and reinvesting it, the compounding quietly year after year. True safety comes from structure, not stasis. A portfolio designed to generate income, spread risk, and adapt to economic conditions offers real protection. It may fluctuate in the short term, but it survives and grows over the long term. Cash-heavy positions lack structure. They rely entirely on external forces behaving perfectly. That almost never happens. Holding some cash is responsible. Holding excessive cash because it feels safe is not. Safety is not about comfort, it's about outcomes. And the outcome of long-term cash hoarding in an inflationary environment is predictable and negative. If you want real safety, then you must accept that some level of uncertainty is unavoidable. The goal is not to eliminate risk, but to manage it intelligently. The cash gives the appearance of safety while quietly guaranteeing loss. That is the illusion investors must break if they want to protect their future. The smartest investors focus on one thing above all else: cash flow. Not stories, not hype, not short-term price movement. If an asset cannot produce income, it must justify itself with extraordinary long-term potential. Otherwise, it has no place in a serious portfolio. Income is the foundation of financial stability, especially in an uncertain economic environment. Cash flow producing assets do something cash never will. They pay you. They work while you sleep. They reduce your dependence on timing and prediction. When markets are volatile, income keeps coming. Dividends, interest, rent, royalties, these are not opinions, they are results. That they provide stability when prices fluctuate and confidence when emotions are high. The beauty of cash flow is that it gives you control. When your investments generate income, you are no longer forced to sell assets at bad times just to cover expenses or rebalance. Income gives you flexibility that allows you to reinvest during downturns instead of panicking. Investors without income are always at the mercy of the market. Investors with income can afford patience. In inflationary conditions, cash flow becomes even more critical. Prices rise, costs increase, and living expenses grow. Assets that generate income can adjust over time. Companies can raise dividends. Rental income can increase. Interest payments can reflect higher rates. Cash just sits there, losing value. The income-producing assets fight inflation by replacing what inflation takes away. Another advantage of cash flow assets is discipline. They force you to think like an owner, not a gambler. When you invest for income, you analyze balance sheets, sustainability, margins, and durability. You care about whether the business can survive bad times and still pay you. This mindset protects you from speculation and emotional decisions. Income also compounds quietly. When you reinvest dividends or interest, you are buying more productive assets without adding new capital. Over time, this creates exponential growth. The compounding does not require perfect timing or genius. It requires consistency. Cash flow provides that consistency year after year. Many investors chase growth without income, hoping someone else will pay more for the asset later. That strategy depends on sentiment and timing. Income investing depends on performance. As long as the asset produces cash, it has value. You don't need optimism. You don't need hype. You need results. Cash flow assets also reduce stress. The knowing that your portfolio produces regular income changes how you react to market volatility. Downturns become opportunities, not threats. Instead of fear, you feel confidence. Instead of selling, you collect. Emotional control is one of the greatest advantages in investing, and income provides it. That this does not mean every investment must produce income immediately. Growth has a place, but growth should be balanced by assets that pay you consistently. Without that balance, the portfolios become fragile. They rely on future expectations instead of present performance. In the long run, wealth is not built by watching numbers on a screen. It is built by owning assets that produce something real. Cash flow is real. It pays bills, funds opportunities, and compounds over time. In a world full of uncertainty, the income is clarity. It is measurable, repeatable, and dependable. If your investments don't send you cash on a regular basis, you are speculating more than you think. The serious portfolios are built on income. Everything else is secondary. Relying on a single asset class is one of the fastest ways to expose yourself to unnecessary risk. The economic conditions change, interest rates move, currencies fluctuate, and entire industries rise and fall. No single investment performs well in every environment. That is why diversification is not a luxury or an advanced strategy. It is a requirement for survival. Many investors believe diversification simply means owning more things. That is not true. True diversification means owning assets that behave differently under different conditions. When one area struggles, another can stabilize the portfolio. This balance reduces volatility and protects long-term returns. Without it, even strong investments can fail you at the wrong time. Markets are cyclical. The growth assets may outperform during expansion but suffer during tightening. Defensive assets may lag during boom periods but protect capital during downturns. The income assets may appear boring until volatility hits and stability becomes priceless. A diversified portfolio accepts these cycles instead of fighting them. Another common mistake is concentration disguised as confidence. Investors load up on what has recently worked, believing past performance guarantees future success. That approach works until it doesn't. When conditions shift, concentrated portfolios suffer disproportionately. The diversification acknowledges that no one can consistently predict the future. It prepares for multiple outcomes instead of betting on one. The diversification also protects against emotional decision-making. When your entire portfolio depends on one asset or sector, every price movement feels personal. The fear and greed take over. But when risk is spread across multiple assets, decisions become calmer and more rational. Emotional stability is not just psychological, it is financial. Income diversification is just as important as asset diversification. Relying on a single income source, whether from one stock, one property, or one business, creates vulnerability. If that source fails, income stops. Multiple income streams create resilience. They ensure that even if one stream weakens, others continue to support the portfolio. The global exposure is another layer of protection. Different regions operate under different economic and political conditions. While one market struggles, another may thrive. The limiting yourself to one country or currency concentrates risk unnecessarily. Diversification across geographies reduces dependence on any single system. The diversification does not mean diluting quality. Every asset in a portfolio should earn its place. Weak assets do not become strong just because they are different. The goal is to own high-quality investments across various categories, each selected with discipline and intention. Some investors resist diversification because it feels slower. It may reduce the chance of extreme gains in the short term, but it also dramatically reduces the risk of catastrophic loss. Long-term success is not about winning big once. It is about staying in the game long enough for compounding to work. The strongest portfolios are built to endure. They do not rely on perfect timing or flawless predictions. They are structured to adapt. Diversification is the structure that allows that adaptability. It spreads risk, smooths returns, and creates consistency in an unpredictable world. Ignoring diversification is a bet that one asset, one sector, or one idea will always work. History shows that bet rarely succeeds. The discipline means accepting uncertainty and preparing for it. Diversification is how serious investors do exactly that. Not all businesses deserve your capital, especially in an environment where money is expensive and mistakes are punished quickly. When interest rates rise and credit tightens, weak companies don't get second chances. They struggle to refinance, they dilute shareholders, or they disappear entirely. This is why ownership must be selective. You are not buying tickers, you are buying businesses. Strong companies separate themselves through pricing power. If a business can raise prices without losing customers, it controls its destiny. That ability protects margins during inflation and preserves cash flow when costs rise. Weak companies compete only on price. The moment costs increase, their profits vanish. Those are not investments, those are liabilities. Balance sheets matter more than ever. Companies with manageable debt, strong cash reserves, and consistent free cash flow can survive almost any economic environment. They don't depend on cheap money to stay alive. They don't panic when conditions tighten. That they can invest in growth, acquire competitors, and reward shareholders while others are cutting back. Earnings quality is another critical factor. The reliable profits beat unpredictable growth every time. One-time gains, aggressive accounting, or unsustainable expansion are warning signs. The serious investors look for repeatable performance. Businesses that generate cash quarter after quarter prove they understand their market and control their operations. The management discipline cannot be ignored. Great businesses are often destroyed by poor leadership. Capital allocation decisions reveal everything. Are profits reinvested wisely? Are dividends sustainable? Are acquisitions strategic or reckless? Leaders who respect shareholder capital build long-term value. Those who chase ego destroy it. The competitive advantage is what keeps profits alive over time. Without it, even successful companies eventually fade. Brand strength, intellectual property, network effects, and scale all create barriers that protect earnings. When competition is limited, pricing power increases. When competition is fierce, margins collapse. You want ownership in businesses that are hard to replace. Consistency beats excitement. Flashy companies attract attention, but durable companies create wealth. The businesses that operate in essential sectors, provide recurring services, or dominate niche markets often outperform over decades. They may not make headlines, but they deliver results. Strong companies also understand cost control. Growth without discipline is dangerous. The expanding revenue while ignoring efficiency eventually leads to failure. Businesses that balance growth with profitability survive downturns and emerge stronger. They don't need perfect conditions to succeed. Ownership means accountability. When you invest in a business, you accept its strengths and weaknesses. That requires research, the patience, and realism. Blind optimism is not a strategy. Selectivity is. In difficult economic periods, capital flows toward quality. Weak companies fade. Strong companies consolidate power. Investors who own quality benefit from this shift. Those who chase speculation pay the price. If a business cannot survive higher rates, the rising costs, or slower growth, it does not belong in a serious portfolio. Strength is not optional. It is the minimum requirement. Cash has a purpose, but that purpose is often misunderstood. It is not meant to be a long-term hiding place or a substitute for strategy. Cash is a tool, and like any tool, its value comes from how and when it is used. When cash sits idle for too long, it stops being useful and starts becoming a liability. The most effective investors treat cash as optionality. It gives flexibility, not comfort. It allows you to act when opportunities appear, not to delay indefinitely. Holding cash without a clear plan is not patience. It is hesitation. And hesitation is expensive in a world where inflation and time work against you. The cash should exist to solve specific problems. Emergency reserves protect you from unexpected shocks. The short-term liquidity allows you to meet obligations without selling assets at bad times. Strategic cash gives you the ability to deploy capital during market dislocations. Beyond these purposes, excess cash has no job. One of the biggest mistakes investors make is confusing readiness with inaction. They tell themselves they are waiting for the right moment. But markets rarely announce when the right moment arrives. By the time clarity appears, prices have already moved. The investors who rely on cash as a long-term strategy often miss the very opportunities they claim to be waiting for. Using cash strategically requires discipline. It means defining conditions in advance. If markets drop to a certain level, cash gets deployed. If valuations become attractive, cash goes to work. Without rules, the cash becomes emotional. Fear keeps it on the sidelines even when logic says act. Cash also works best when paired with a system. Regular investing, rebalancing, and income reinvestment all reduce the need for large idle balances. A structured approach turns cash into a temporary holding state rather than a permanent allocation. The systems remove emotion. Cash without a system amplifies it. Another danger of excess cash is false confidence. Large balances can create the illusion of control. But control over timing is rarely real. Markets move faster than emotions can adapt. Investors who hold too much cash often deploy it poorly, chasing rallies or reacting late to downturns. Strategic cash is calm and prepared. Excess cash is reactive. Cash should also be evaluated relative to opportunity cost. Every dollar sitting idle is a dollar not compounding. It earns nothing while productive assets generate income and growth. Over time, this gap becomes enormous. The strategic investors understand that the biggest risk is not short-term loss but long-term underperformance. There is also a psychological cost. The cash-heavy portfolios encourage constant monitoring and second-guessing. Every headline becomes a trigger. Every market move creates doubt. The investors with structured allocations spend less time worrying and more time executing their plan. Using cash properly means accepting that you will never deploy it perfectly. That is fine. Perfection is not required. Progress is. The goal is not to wait for certainty but to act with reason. Cash is there to support decisions, not replace them. In the end, the cash should move with intention. It should enter your portfolio with a purpose and leave it with conviction. When treated correctly, cash is powerful. When treated as a strategy, it is destructive.